In this video, I want to compare the risk graph between naked put, covered call, and a poor man covered call strategy. In fact, the naked put and a covered call has the same risk graph or risk profile. Some people might not be comfortable with trading a naked put option because a naked put option is traded on margin, and some people might not feel comfortable. But if you are allocating 20,000 to trade a covered call and you allocate 20,000 to trade a naked put, then you have the same risk graph and risk profile. Let's take a look at the risk graph of a covered call position first. For a covered call, you basically buy 100 shares of the stock and you sell a call. Let's take a look at the 120 days to expiry at the money covered call. You can of course do a in the money covered call, at the money covered call, or out of money covered call. But in this video, I will just illustrate at the money covered call. The at the money call option will be the 229. And we can just buy a cover stock to confirm you are buying 100 share of the stock and you're selling one call this expiry at the 229 strike, and we can just analyze trade, but we will come back to this later. Let's look for a naked put that is also 229 with the same expiry. That will be this one. If we are doing a naked put, we are going to sell, and we will come back to this later. Now let's try to initiate a poor man covered call. For a poor man covered call, you're basically selling a call option, the at the money call option, and we are buying a dip in the money. Let's choose the 194 because that is the example that I used for the previous video. So we'll just stick with this. Buying the 194 dip in the money call option and selling the at the money call option. And the debit is around 29.50, and that is the maximum risk. Let's take a look at the risk graph. Okay, so now we have all the three. Let's take a look at the covered call first. For the covered call, this is your risk graph. If the market stay above 229, this is the maximum profit that you can make, which is about $637. On the downside, you have unlimited risk all the way to zero. If the stock were to drop to zero, then you're going to lose 20 over 1,000. But will the stock drop to zero or not, that is another totally different issue. But that is the risk of a covered call all the way to zero. And let's take a look at the naked put. The naked put has similar risk graph because you're carrying an unlimited risk. If the stock drop all the way to zero, you are required to buy this stock at 229 because that is the strike that you sell when you initiate the naked put position. And the profit you can make is $716. It's quite similar to a covered call. The plus minus difference is because the stock is not exactly at 229. The stock is at 229.24. With that being said, a naked put and a covered call has a similar risk graph. And now let's take a look at the poor man covered call. The poor man covered call will have a different risk graph. The risk is only limited to the debit pay, and which is 2,950. And the profit is slightly lower than a covered call or a naked put, but not by too much. The profit, if the market is above 229, will be $550. That is a very good risk graph as compared to a naked put or covered call where the risk is all the way to zero and the risk is over 20,000, the poor man covered call look attractive based on the risk and reward. Poor man covered call would be a strategy that you want to be seriously looking at. I'll be going more in depth into all these 3 different strategies in the other part of the video. Thank you.